Hey, my name is Ronit, and with my partner in fintech crime, Gaurav, delighted to have a repeat guest. Wiza, thank you for joining us.
Thank you so much for having me once again, Ronit. It's always a pleasure to be here.
So Wiza, where in the world are you zooming in from today?
Johannesburg, South Africa, land of amazing weather, great food, great wine, some electricity.
Some electricity. So greetings from Paris, the land of great wine, plenty of electricity. Not sure about great weather though. Not sure about
Can I just say, since we're talking about wine and everything, Ramadan Kareem to everybody. I think it's perfect timing for me to right here into our podcast.
Yeah.
Gaurav is, of course, at home base in Dubai.
You got it, brother.
Awesome. So you're covering 3 continents today. Wiza, for the people who don't know you, tell us a little bit about your journey into the world of fintech. How did you get involved in tech and in fintech?
Right. So I'm someone who considers myself a career techie. Not that it's been a very long career, but for its entire duration, it's been exclusively in technology. So born and raised in Malawi, I spent about the first 20 years of my life there, built a bunch of interesting businesses in Malawi, mostly around websites and mobile web and web hosting. Ended up building the first website for the National Police Service, which is something I'm pretty proud about. And then, moved to Kenya to studied information systems tech at the American University, USIU there. And that was like a pretty big eye-opening moment because Malawi is a small market and Kenya is like a pretty big market, and got to see really the rise of the mobile web in Kenya alongside M-Pesa and smartphones. That was very, very exciting times. Co-founded a market research business there, raised a little bit of VC money, ultimately didn't work out, and then started getting into the telecom space, working in business development and international expansion at one of Kenya's largest startups, Africa's Talking. And while I was in telecoms, I got to see the advent of mobile money. M-Pesa just launched their developer APIs in Kenya, and you started to see like a lot of the adjacent themes that we're seeing in telecoms in fintech. And I was like, wow, this mobile money thing is very, very exciting. And, got into that about 6 years ago. So since then, I've worked in roles at Africa's Talking, at Harvard Developer Services, and also at Chipper Cash, where I previously led global merchant business across the group, helping businesses collect from 6 million users across various African countries and be settled in one major global currency. And yeah, now I am currently unemployed, taking a bit of a break, and hoping to figure out what's next over the next few weeks.
Wiza, you touched upon lots of really interesting points there, including the growth of mobile web and mobile money in Kenya. And in many ways, Kenya is the cradle of the birthplace of mobile money at scale. I think there are other countries that might have done mobile money earlier in a small way or in a medium-sized way, but in terms of scale, if there's one thing that anyone in the world knows who's in fintech, there's one thing they know about Africa. It's M-Pesa, right? Tell us a little bit about why Kenya became like that cradle of mobile money, and what conditions were in the water or in the air on the savannah that allowed this to happen in Kenya in such a big way?
Yeah, I think it's quite an interesting combination of factors. A pretty big one being timing. The time was really just right for M-Pesa to explode in the way that it did. And then one thing that certainly helped was that Safaricom had a very dominant position in the market as a telco. It was the only really strong domestic telco. The other competition was from players like Orange and Airtel and Telkom, who are all foreign owned. So it was a little bit of a national treasure with a very strong government interest and government shareholding. And you combine that as sort of like the environmental base, right, that enabled the product to grow. And then you also have like a very, very significant need. So, Nairobi is really the economic center of East Africa, and certainly that of Kenya. And what was initially driving that traffic was the need for people to facilitate domestic remittances in a cheap, easy, and secure way. So a lot of people are trying to send money back home. They come to the city, they're working there, they make a little bit of extra cash, and they want to make sure that people back home can get to participate in the creation of their wealth. And it came in really to solve that problem. And because of that, there was a very large set of early adopters. I think one theme that I see with a lot of fintechs in Africa today is that it's very hard to find a large set of early adopters. You can find a set of early adopters, but it's like, it's Wiza and Gaurav and like 6 other people from CFTE. And, that doesn't really get your thing to launch the way you want it to. So they had
you went to Stanford and you hang out with the right VC.
Yeah, you see what I mean? Like, those are the people, they'll definitely try it. Like, I think like, with Web3.
And then you go and pitch to some American dude and say it's the next Brazil, and then you're sweet.
Yeah, you're on your way. So like, like with Web3, like, say similar things are happening right now in Nigeria, right? Like you see Nigeria and it's like, why is it one of the leading per capita users of crypto in the world? It's because there's a fundamental need that's being solved there. In a very tangible way. So those factors came into play. And then a really, really big one, I think, was the enabling regulatory environment. I think many telcos had tried to foray into mobile financial services in some form or fashion before, but typically bank-based regulation would block that. But in Kenya, they managed to come up with a regulatory framework that essentially allowed the value to be built on top of bank infrastructure rails. And this is pretty much the case till today. All of the money that sits in M-Pesa sits in a trust account in NCBA Bank in Kenya. So they managed to come up with a very compelling regulatory framework and experiments with it. Now, one thing that people rarely talk about that really underpinned M-Pesa's success was their effective acquisition of mobile money agents, especially in urban areas. So there's a pretty good article that came out, I think, yesterday by Caleb. I'm trying to find his last name, and he documented the M-Pesa journey very, very clearly. And he had an interesting chart that goes to show the usage of mobile money as a function of proximity to mobile money agents. So in environments where it takes more than 30 minutes to get to a mobile money agent, people rarely use mobile money. But if you can drop that distance, like walking time to a mobile money agent to 5 to 10 minutes, then the uptake of mobile money services dramatically improves. And if you look at like Nairobi as an example, you can't walk for like 10 minutes without bumping into an M-Pesa agent somewhere. And the article is from Caleb from Tech Safari. He writes a newsletter called Tech Safari. And he wrote about the M-Pesa journey. Very, very compelling story around that, the agents, the role that agents played in getting M-Pesa to where it is today. And if you look at the states of it today, they haven't stopped doubling down on that investment. I think in Kenya alone, they have over 300,000 agents, right? One of the largest of any African country. And those factors came in at the right time to build the mammoth that it is today, processing, equivalents of over half of Kenya's GDP digitally. People trust it more than cash. Like, cash is so inconvenient in Kenya these days, especially for smaller transactions. You can take a border ride and like pay your guy with M-Pesa, and it's just like, it's by default. It's the way my friend describes it, it's ubiquitous to the point of invisibility, which is a very, very amazing journey indeed. And I think they're only getting started. They haven't yet started really building out robust credit mechanisms, robust savings mechanisms. There's a lot that's going to be built there.
They're only just getting started. There's so much there I want to unpack. But before we do, could you just repeat the name of the author in the article you mentioned, so that maybe our friends at CFT who produced this podcast can add it to our when we release this pod, they can drop it into the show notes, or we can link it into social media as well to reshare.
Absolutely.
Good content.
Absolutely. So that's from Caleb from techsafari.io. He doesn't use his full name, but yeah. He's a pretty great writer,
Really?
one of the ones that I follow.
Right.
And yeah, he's pretty great. He's pretty great.
Cool.
Caleb Maru.
Okay. We'll make sure
Yeah,
we
Tech
try to
Safari.
possible link that into the show notes. So there's several things you threw out there. Number one, M-Pesa scaled rapidly, a lot of early mass adoption because it was solving a real pain point. Effectively, the pain point it was solving was that to move money around Kenya, like many countries, you had to physically move it because most people didn't have a bank account. And particularly for the migrant workers, the internal migrant workers going back to their hometown or village, the alternative was the bus driver or the friend going back to see their spouse or their mother or whatever. So there was this real obvious pain point that was being solved. Then the other thing that was being solved in terms of wide scale was they were everywhere through a physical and a digital strategy. There are all these agents, the physical, which is, I think we've talked about before, like sometimes people forget when looking at Africa that there has to be a strong physical component, oftentimes, even in a digital solution. And the third, the timing was right, he said. The timing was right because I guess feature phone adoption had become, if not ubiquitous, had taken off by then. And that was the timing was right for them. You didn't need smartphones for this. And then what else was right in terms of the timing? Because I think you stressed that, Wiza, before, like it was just the right time. So apart from the phones were there, the regulator was supportive. Was there anything else that was in the water or that, why was it 2000 and, I can't remember now, correct me, I'm going to face fact check me. It's 2007, right? Took off.
Yeah, around 2006, 2007. I think 2007 is really when it really picked up. And there's a great graph here from Caleb's newsletter. I'm hoping that we can put it in editing in post.
Sure.
And one thing that has been very interesting is that from in the initial days, the transactions per agent per month, that stayed relatively consistent. But the number of agents and customers grew exponentially. And to me, that implies that like there is an obvious cap to the number of customers that an individual agent can serve, right? But if the customers and agents numbers are still growing, and they are still growing to this day, it's possible that they haven't reached the cap in terms of the number of agents that they need to really saturate the market. But going back to your question originally around timing, I think it was also a time where there was a lot of positive sentiment around technology in general. Like phones had come in relatively recently. It was a relatively young industry in Africa. And we were starting to see, the first data-enabled SIM cards coming in around that time. And there were a lot of like interesting possibilities. So I think people were also like very curious to understand, okay, this thing, I can talk, I can do this. It was really like game changing. I don't know if you can remember the first time that you ever got a cell phone and started to really understand the implications of that. I think there was, much like now with Web3, definitely no NFTs and people shilling things, but a very strong sense of optimism around the possibilities that the technology unlocks. And what I think went right in that scenario is that because there was a robust regulatory framework, and you might see me drawing quite a number of contrasts with what's happening in the crypto space today, the absence of a robust regulatory framework, I think, works to the detriment of the development of the technology, because there's no, safeguards to enable people to experiment with it in a very safe way. So I think that really was a major factor, but it's very hard to point to what is any one thing that made M-Pesa successful. It was a combination of all of these factors combined with the timing, combined with the right regulatory environment. And I think literacy also plays a pretty significant role relative to some other countries in sub-Saharan Africa. Kenya's literacy rates are significantly higher. And people are able to grasp these new concepts much more quickly. And now, people are born into a world where your mental model of what money is defined by mobile financial services. And I think that's a very powerful thing. So I'll spend a few minutes just like unpacking it. When you're born into the world, right, like nobody really has to explain to you why, like, you know, $100 bill has got value. You sort of just like observe people passing these bills around, and you like start to realize and trust that like, oh, this is money, and like if I want to buy stuff or
What is money?
preserve value, yeah, like no one ever really asks that, right? It's like your mental model is defined around like, hey, this is the thing that we use, and you never really have to question it, right? And I think today they've gotten to that scale where, you know, people who are being born into this mobile money first world, they might even find it absurd to like, oh, what, the cash transaction for this? Like, why am I carrying all this money?
Piece of paper. What's this?
Yeah, it's like it's I know it sounds sensational, but like really that's the reality that we're living in today. So yeah.
Yeah, no, we live in a world of bytes, not atoms, right? Bits and bytes.
Yep.
Yeah. Now, in terms of just a couple more questions before handing over to Gaurav, just two threads I want to pull out. Number one is, it was really successful in Kenya, and for a variety of reasons, it's only now, recently in Nigeria, we're seeing mobile money beginning. In South Africa, it's been tried, it's kind of worked, didn't really work. In the other big, I know, I'm sorry, apologies for the massive generalization, because we all know, not as well as you do, but we all know the diversity in Africa. But question that always comes up is, why did it work in Kenya and it didn't work in, I don't know, South Africa or Egypt or Morocco or in Nigeria? If you had to like do a TLDR or a quick summary, what was the, why was it not a Pan-African phenomenon? Why was it such a sort of East African phenomenon?
Yeah, I think, I think the response for specific countries is very different, right? So if you look at South Africa, it was primarily because there was already an existence of very mature domestic transfer rails. And in South Africa, a bank account is aspirational. It's something that people aspire to have, right? I want to have a bank account so I can get my EFT transfers. And, you know, there've been so many attempts by various providers in the telco space to enter mobile money in South Africa. And, you know, they've seen limited degrees of success, nowhere near the scale of what M-Pesa has done in Kenya. I think another thing that's a very big contributing factor is that South Africa doesn't really have a robust regulatory framework for electronic money to exist outside of a bank account. So it's not a thing. So all the mobile money implementations, you find that at the end of the day, the value is sitting in an individual bank account in, you know, typically one of the top 4 or 5 banks in the country. And I will stop short of saying that there are entrenched interests that want to protect that status quo. But that's the argument that some people have certainly made, and it's very hard for mobile money to exist outside of that framework. Very similarly, in Nigeria, you have the same sort of principle that governs the growth of mobile money. I think Nigerian banks saw what was happening in East Africa and preemptively took appropriate steps to ensure that if the same phenomena were to occur in their markets, they would not be disintermediated in quite the way that the banks have in Kenya specifically and East Africa more broadly. So I think that the regulatory piece plays a very, very big role. And then also the degree of trust in financial services. If you look at Nigeria, for example, compared to other African countries, it's a relatively low trust society. So people take a bit longer to catch on to new concepts and to understand what sort of possibilities can be unlocked. Thankfully, now the banks have really caught up and developed solutions that address the mobile money challenge in very compelling ways. For example, with the BVN, I feel like every podcast I get on, I always sing about the BVN. It's like, it's really amazing. Just 11 digits and your phone number, and you can onboard in a compliant way to like pretty much any financial service you want up to a specific limit, right? And that limit covers like, you know, 95% of people in Nigeria, right? So it's pretty interesting to see how they've taken the best lessons from telco-led mobile money and implemented it in the banking system. And now you have this like massive explosion of mobile money, you know, fintechs in Nigeria, like Chipper, like Paga, which has over 17 million users, right? Like it's actually pretty insane the scale at which some of these services operate. I can't speak authoritatively to Middle East, North Africa, that region, and why the solutions really didn't pick up. I just don't have as much context. But certainly for South Africa and Nigeria, those are some of the reasons why it didn't really take up. If you look at markets like Uganda, Zambia, Rwanda, which are similar in characteristics to Kenya, in the sense that you've got a similar regulatory framework, but you don't see as much progress because there was also very healthy competition between 2 or 3 telcos in those markets. So take an extreme example, Tanzania has got 4 major telcos, and no one of them has been able to scale to the level of M-Pesa because, M-Pesa Kenya, you still have M-Pesa in Tanzania, but it's nowhere near as big because you have this healthy competition between the telcos. But what's interesting to observe from markets like that is that the consumer really benefits. So you have like really low cost of data, really low cost of transactions, lower interest rates on credit products, and things like those in markets like Tanzania. And yeah, I think those are the reasons why things played out differently. And it's still very early days, right? All this mobile money, all this fintech, all this unicorns, all this MTN group, all this Airtel group, all of us combined and our families combined are still processing just less than 10% of retail transactions on the continent. So it's early days, very early days for sure.
Now, just on that point of early mass adoption, and you threw out some names of fintechs that have taken off recently in the last 3 years, such as Flutterwave and Chipper Cash, Paga, and others. What are the verticals or activities within financial services or fintech that if you were building a fintech, you go, that I can get early mass adoption here? And do you think that some of these that have become quite famous, quite highly valued in the last 2-3 years, do you think those fintechs are kind of proven, as in they've established mass adoption, or did they just become well-known and, because we were in a fintech hype cycle, we're in a funding hype cycle? How resilient? We don't have to name names here. We're not trying to call out, just to be put into context. We're not trying to call out anyone. We're not trying to badmouth anyone. We just want to get to M-Pesa has been around for 15 years. It's demonstrably had product market fit early in Kenya. In fact, it even pivoted. Originally, I think the guys who, men and women who built it out of Vodafone, and they were thinking about a complete different product. They were thinking about it being a kind of sort of micro credit type product, and then sort of consumer feedback was like, no, we need this for payments, and then we can go back to credit. So it just hit product market fit really fast. These last 2 or 3 years, and there've been good and bad things about it. And the good thing is obviously, speculation and money sometimes is needed to fund innovation. But how real and sustainable? When we all get together again in 10 years' time, obviously we'll chat before then, maybe in a week's time when you come to Dubai, but let's say we're, drowning drinks on Garo's boat in 10 years' time, right? I mean, how many of these fintechs are still around? Are they a flash in the pan? Or they're kind of a VC, how should I put it politely? VC.
Well, I think the truth is somewhere in the middle, right? I think there definitely was a lot of money in the system, and I think that many businesses and many founders set unrealistic expectations for both themselves and their investors because of the very rapid influx of capital that came into the system over the last few years. I remember in 2016, the total amount of VC raised by the entire African ecosystem was circa $320 million or so. And, 2021 was in excess of 5 billion. So there's a lot of capital chasing very few credible opportunities. And, a lot of money was injected into the system. And my worry is that it ended up forcing businesses to adopt unsustainable market killing practices. So For example, if you're doing like negative rates on cross-border transactions, and like these rates don't exist. The only way they exist is if you're losing money. You train the consumer to expect that from financial services and distort the market reality. So now that the anvil is coming down and the economic realities are forcing both investors and operators to start to think more seriously around unit economics, some business models just won't survive in that landscape, right? And it's a sign of the times. It's been growth at all costs to like, hey, contribution margin, which is a common theme that we're hearing all across the board, right? And I think that's ultimately good for the ecosystem, good for the consumer. I think there's going to be a lot of consolidation, and we've already started to see it. There's MFS Africa who acquired Baxi, GTP. There's a Kenyan company recently that just acquired a smaller business in their sector. I think they were like doing supply chain automation. You're hearing a lot more about M&A style deals than you are about individual raises, right? Which I think is ultimately good. And then I do think what's going to happen is that some businesses, unfortunately, will die. That is just the fundamental nature of the space that we're in. But we're also going to see some regional winners. I think we're going to see some very strong regional winners just because of the cultural differences between specific regions. And, at a very broad macro level, like Sub-Saharan Africa and North Africa are two different animals. And I've not yet seen a lot of crossover from businesses from other side. Eastern Africa and Western Africa are two different animals. Right. And then Southern Africa is its own animal, except South Africa, which is also its own animal, which is pretty interesting. So I think there's going to be regional winners. There's going to be more M&A. Fair Money just acquired a company called Payforce in Nigeria. Reasonable valuation, somewhere between $15 to $20 million, probably a mix of cash and equity. If you had said that 5 years ago, there was no founder who would have told you that that's a bad outcome. But in 2021, you tell somebody that like, hey, I want to buy your company for $15 million. $15 million? What do you think I am? What do you think this is? It was crazy. It was very crazy. So yeah, we're gonna see. I think that's how it's ultimately gonna play out. There's gonna be some continental winners as well. I think some of the big players like MFS Africa, Flutterwave. I wouldn't say that they're too big to fail, but at this point they're systemically important fintechs, if I can borrow from the Fed. So they need to be protected.
They've reached escape velocity.
Yes. They're systemically important fintechs. So yeah, I think that's how it ultimately plays out.
I want to dig a little bit more into your experience at Chipper in particular in building fintechs, but I think Gaurav is much better placed to help unpack those company specifics. So over to you, Gaurav.
Thanks a lot, Ronit. Wiza, great to have you back on. Last time we had you on our podcast and our show with our audience, we were talking about the blistering, attention and focus on the continent and several spaces of what was happening and why it was happening and what felt like, again, optimal time for it to happen in these conditions, right? Very much like we were talking about, and suddenly things have come to, has it come to a screeching halt? I don't know. So it's great to get your perspective on a number of things, but let's first start with, as Ronit left off, let's talk about your journey at, Chipper Cash. What's happening there today? What's the landscape at that particular company itself and its evolution? How are they now embracing the current scenario in the markets?
Yeah, I would say that it's definitely been a very big shift from even last year to this year. I think the founders of Chipper have been particularly responsive to market conditions and have acted decisively, making painful decisions to lay off individuals, for instance. I think We've had two subsequent rounds of layoffs just before I left. Fortunately, my role wasn't affected, but like I also just really just needed a break and to just chill at home for a bit, figure out what to do. But I think they've responded appropriately by making those changes and doubling down on markets that are working, and then just like dramatically improving the unit economics of various components of the business. And I think that ultimately that response to those market shifts is going to work in their favor. That doesn't mean to say it won't be painful. That doesn't mean to say there won't be disappointment, so that, you know, it's always tough to lose colleagues, and so various stories coming up in the media, lots of different speculation. But I think it's not isolated to them, right? Like Amazon yesterday, I think laid off 9,000 people. Facebook Meta now has had 2 rounds of layoffs affecting several thousand people. I think we're going to see similar themes for quite a while. But I think ultimately the company, by responding appropriately to these market shifts, is putting itself in the best possible position to survive. There's also like a lot of investment that went into licensing over the past 2 years. So, you know, while I was there, we acquired quite a number of new licenses in various jurisdictions and really strengthened the compliance infrastructure, brought in some very, very talented people, and streamlined certain operations. And I think that opens up various opportunities. So, you know, for example, I was working on merchant business and merchant solutions, which is actually quite complex when you're collecting a bunch of different currencies from various baskets and to settle somebody in US dollars. There's a lot of moving parts. And you see a lot of interest now from large global merchants who are looking to localize their payment solutions in markets that have exchange controls like South Africa and Nigeria, where, you know, people have now, because of smartphone adoption, people want to subscribe to Spotify. They want to, you know, play Call of Duty Mobile, and, you know, they want to get Xbox Live. How do those people pay you, right? That's becoming a very interesting theme. And I think ultimately that's what's going to direct the future of the fintech industry. If you look at the biggest players on the continent today in financial services, if they're not banks, they're typically serving foreign-based businesses. So MFS Africa, who are some of their biggest customers, people who are remitting into Africa. Flutterwave, who are some of their biggest customers. You know, Emirates is trying to collect Malawi kwacha from Wiza in Malawi so that he can get to Dubai, and his Standard Bank card, unfortunately, won't work for international transactions. True story, yesterday, my cousin runs a fashion business in Malawi, where I'm originally from, right? She needed to make a PayPal payment to somebody in China for $1,056.62. So she maxed out the international transaction limit on her card, and then she sent me the money in Malawi kwacha as a domestic transfer to my Standard Bank Malawi account. And I have the highest category of individual account you can have. It's a private banking account, top of the line. You get your little suite, whatever. It's the best account. And I had to email my relationship manager and ask her to unlock the card for me to do an international transaction. And then even then she responded and said, you need to attach the invoice for what it is you're trying to pay. So only after I send the invoice is when I could make the international card transaction, right? And this is in Malawi, and my cousin just like buys and sells clothes, right? And there's like millions of people all over Africa like my cousin. And that's where I think the really big opportunity is. How do you, I think we've done a pretty decent job of making finance within the continent somewhat interoperable. Like, it's far from perfect, but you know, you can do stuff. But now, like, paying globally, paying outside the continent, oh, that's still a very big pain point. And I think we're going to see a lot of investment into that region, and it's going to really shape how, you know, the next 3 to 5 years really plays out.
I think, you know, it's very interesting. We've touched on a number of points and categories of interest during this session that we're having with you on the state of what companies are going through during, you know, slower periods of funding or tougher periods of funding, you know, especially when they were chasing growth, with the tactics changing on how to operate and sustain and deploy business economics before But I think, if we really look at what the VC model is, I don't think the VC model has ever been 99% success and 1% failure. I think it's always been 1% success and 99% or 90% failure, right? 1 in 10. I think the problem with everyone tried to get to a space too quickly, believing the same market conditions that exist in Europe or in the United States with exits applied to markets that were just starting out their technology on a mass scale growth trajectory potential, given infrastructure that happened, right? Mobile, telco, data, information availability, systems talking to each other, or global interest in the continent, or the continent being able to interact with international markets, right? But having said that, and we've talked about a number of businesses, a number of pivots, a number of issues, are you still seeing investments coming in to later stage companies, or is it only early stage companies, or is it just not happening at all? I mean, what's the state of funding that you're being exposed to out there at the moment?
Yeah, so I think the point about market comparisons is very pertinent. I think 2020, 2021, it got to a point where businesses targeting the African continent could raise on terms as if they were targeting very large markets, Nigeria, giant of Africa, 200 million people, right? Big country. The GDP is equivalent to the greater Boston area. Right?
Context, right? Exactly.
So I think there's quite a lot of sanity returning to markets on the continent. There was a time where Tej Kene Okafor, who's the resident writer at TechCrunch, him and Anne Karanja cover the Africa stories. Tej was publishing 2 times a week about X startup has raised, and the minimum thresholds to get on Tej's radar for a story is $1 million. I was publishing 2 times a week, right? It was amazing. It was amazing. I don't remember the last time we published now about a fundraise.
No.
When was peak Tage?
Yeah,
we can honestly, have a phrase like peak rage, peak Tage.
Yeah, it was when was
it in your inbox every nanosecond.
Yeah, it was amazing. And now there's definitely been a slowdown, especially towards later stages. I think with also the increased interest rates, the risk profile has changed, and late stage, companies in the most emerging markets might not be very appealing to some of the largest custodians of institutional capital. I don't see as much of a slowdown on the early stage. So, pre-Series B, I do see quite a lot of activity. I think a lot of fund managers were able to secure quite a bit of capital, and the fund duration for some of these funds is 5 to 7 years, and I think a lot of that capital hasn't been deployed yet. So there's still opportunities, but definitely the risk profile has certainly changed. Now, VCs are asking for more solid metrics for earlier stage companies before they're able to make investments. And I think that this trend is going to continue. And I don't think that we're going to, feel it as much maybe in this cycle, because a lot of the money that was raised up until 2020, 2021, I don't think a lot of it has been deployed yet. I think there's a lot of dry powder still available for the continent. But maybe 2-3 years down the line, I wouldn't even dare make predictions about what the global macroeconomic picture might look like. But if we haven't recovered, if interest rates are not as reasonable as they were before, then we might see a very, very significant slowdown, more so than what we're already seeing now. And just to be clear, we are seeing a slowdown now, but I don't think it's the worst of it. Things could get worse, but maybe some years from now.
It's very interesting. What you're describing is very much an echo, or a mirror, more accurately, of what's actually happening in this region as well. And what I'm seeing elsewhere in my portfolio exposure, I'm seeing emerging ecosystems that actually operate in volatile conditions from an economic or a currency or a geopolitical position, actually being very resilient to the current climates and being able to reshape their businesses in growing. In particular, that's the continent. I mean, when I talk to a number of investors, VCs, and read a lot of the news that's happening out there, and personally doing some acquiring of businesses myself, the reports I'm getting in from portfolio companies in the continent is we're growing. Like, we're still growing, we're still on track, we're still moving, we're still, and we're still looking to trim cost. And by the way, we're raising a round and we've closed 50% or 25%, or we're on way to closing 100% of our round. And I'm seeing this not much panic in the sentiment or resentment in that space. I don't know. Do you think that founders generally have thicker skins or the ability to navigate choppier waters when it comes to this sort of current market climate than other ecosystems? What do you see?
Yeah, I think there's like a natural resilience that a lot of African founders gained from being African founders, right? So they already went through like the 300 rejections. One of the founders I admire most, Benjamin Fernandez from Nala, like he'll tell you that he had a spreadsheet of like 300 plus investors who rejected him, and like now Nala, they did their Series A round, I think $10 million last year. Somebody like that is not going to cry because 10 VCs from somewhere down the road have said, oh, we don't want to invest in your business. Like there's an incredible amount of persistence and resilience that these founders have built. And I think no matter what the market conditions are, great founders will always be funded. And because it's always been hard as an African founder to raise money, you had to truly be exceptional in many ways that many other founders from some parts of the world didn't have to be. They're not really affected by this. I think it's going to be I did get the sense that there was quite a bit of fluff coming into the ecosystem at some point, 2020, 2021, just like random young founders with random ideas raising 2-3 million. And a part of me struggles to reconcile that, because when I was a founder, that wasn't the case. If I had been a founder in 2020, I could have probably raised a couple million, based off of my name alone, right? And it's hard to reconcile that. Like, am I just being perhaps envious that I didn't have those terms? But like on the flip side of that coin, I think it's also harmful if founders raise too much money too quickly. So I think like where we are is a net positive for the ecosystem, where it's definitely harder to raise, but then the founders who are building viable businesses, who can weather the storm of what it takes to build a startup in Africa, I think those ones will still get funded. Like once you have the money, there's still like other challenges that you have to deal with as an African founder. So if raising money is stressing you out to the point of feeling like you're going to be defeated, maybe this might not really be for you, because you haven't started dealing with the other stuff yet, right? So I think that resilience is going to show, it's going to continue. Nigerians supply their own electricity. So I don't think you can shake them with small macro, Jerome Powell interest rates. They'll be fine.
I love that response. I love that. And this while we're talking about resilience, I see the resilience in operating the business as well. But I don't want to focus on that operations, because that shows on the results anyway. That's clear. But one thing I do want to talk about, another thing that I see, from a global perspective on a portfolio level, is what I'm noticing is where this scenario that we're all talking about, again, from too much money perhaps being raised too fast for very young founders or younger founders, I think I'm also seeing in a general trend, and I'm wondering if this is relevant for your market as well, is where operational inexperience at a founder level, a VC level, and a board level tends to yield catastrophic results, even when there is opportunity for M&A and everything else. I've seen entities where companies have solid foundations, and because conversations don't happen in the right framework between the ownership and the operations and the management and the stakeholders, it becomes worthless overnight or in a much faster period. And I'm wondering if that's the same state of the union, so to speak, when it comes to these sort of companies out there. Are they crumbling really fast? And is, from an operational point of view, companies crumbling fast just because of inexperience where there's opportunity? Or do you think there's operational excellence where, again, that resilience will show through with experience on the founder level, the VC level in the continent? Is it too young? Are we too early? Or do you think a lot more will survive than the general markets, the emerging markets, where there's been a lot of fluff?
Yeah, I don't know. I think it's really too early to make that call. So I'm not going to make that call. But some themes that I do see are that, like, I think because of the distorted fundraising environment that was existing before, some founders, not all, sort of like developed a sense of ego and are taking long to report with their fundamental problems and not responding appropriately to the market, you know. Some people haven't yet come to terms with the reality that, like, okay, maybe you might not be able to raise another round. And, you know, the founders who are responding to that appropriately are the ones that you see who are cutting costs, you know, making very difficult decisions like layoffs, like shutting down markets. Whereas other businesses are waiting up until it's too late, you know. And, you know, it's very difficult to have an opinion around issues like this without having full visibility into what's happening in individual businesses. But I think there were 2 startups that shut down in Kenya just last week, right? And I think we're going to see quite a bit of that. Venture-funded businesses that are suddenly shutting down. And I think that does speak to a degree of operational lack of experience, right? Because now, you know, after shutting down 2-3 companies in my past, if you're my investor and something is on fire, you're going to be the first person to know. You're not going to read about it in TechCrunch, right? I know that because I've gone through the journey and I've seen the alternative of what happens if you don't. A lot of the younger founders, unfortunately, haven't been through that journey, and they don't have a mental model for how to do that safely. And I can tell you it's very scary, right? Like, when I was shutting down my business in 2015, I had only raised $30,000, and I paced back and forth for 2 days before I could call Mbwana Ali from Savannah Fund and let him know that, like, boss, this thing is not working. And even when I did, I thought it was like gonna bite my head off. I thought that, like, you know, I might be sued or go to jail or something. And these things, like, they sound ridiculous when I'm saying them, but, like, many founders don't actually know where their margin of psychological safety ends. And I think that's the real issue, right? Like, in that fluffy fundraising environment, I don't know to what extent founders got to build meaningful relationships with their investors to be able to share what's happening when things are going wrong. That time, it was amazing, you know, rocket ship, hockey stick graphs, like, oh, it was amazing. It was such a beautiful time. But now, you know, reality is kicking in, and I don't know if those structures exist. So I'm going to say it's too early to call, but definitely there are some patterns emerging.
It's super interesting. I was talking to a friend in New York who also is a well-known fintech investor. I won't take his name here because I haven't got his permission to say it too out loud, but there was an article in TechCrunch which clearly stated just before the funding winter kicked in, saying operators at a VC level for startups are completely irrelevant, baseless, and useless. And he shared this with me, and I said, TechCrunch is saying this now? Like, this is the time. And him and I were just laughing because we said this is the time that operators can really step in with relationships, know-how, and save companies, or even get them to a bridge to get acquired in a reformat. And I thought it was pretty bold of TechCrunch to put something like that out there, and I thought it was crazy. And I don't know who the author of that article is, but I thought it was absolutely nuts, because I think operators are absolutely essential to what's happening in the M&A market that's going on right now. Otherwise, there wouldn't be any navigation for all these dead bodies that are washing up. At least we can save jobs and reappropriate IP. But I digress. You know, there's always a silver lining in these scenarios. And one of the things I want to talk to you about is, if people are shutting down companies and, you know, there is a lot of movement of people being laid off, do you think there are going to be new companies coming out of some of these, you know, talent pools that are sort of now have time on their hands? Do you think people will look for more stable jobs in that market? Do you think people will be less encouraged to start their own companies? Or do you think people will say, you know what, I have the confidence to build a business with teams coming out of these scenarios and start new companies? What do you think will happen?
I think it's going to be a pretty big mix. So a lot of people are first generation tech workers, right? And like they had a very nice soft landing. I've been working in tech for 17 years, and some of the things I used to hear in interviews from potential candidates in terms of salary expectation, benefits, giving them a car, it was a very, very warm, loving environment. And I think that for some people whose mental model around tech has been built on that, it's going to be challenging to adapt to what's happening when
You mean
don't
reality?
have the lowest interest rates in 14 years, right? So I think that's going to be tough for a segment, and there's a significant segment. And then there's also going to be a bunch of people who don't have a choice, like who need to like figure something out, otherwise the lights are going to go off. And those are the people that I'm really excited about, making sure they get connected to the right backers, because remember, a lot of dry powder still hasn't been deployed. And now VCs are going to be more conservative. But somebody who's gone through that cycle, who's seen the peak and the trough, I think that's somebody who is going to be a bit more level-headed around starting a business, right? So I think we're going to see a segment of people going to that as well. I also think there's going to be people who are going to want to try again in other sectors or in adjacent sectors, people who had been curious about like, oh, what happens if I get into this space? I think there's going to be a lot of like talent mobility globally, because like a lot of the skills that they've gained are applicable to businesses that are from other markets, but perhaps operating in Africa or even operating globally. If you're a customer operations person on Intercom, it doesn't mean that you've been trained specifically for Nigeria. You can work for an Argentinian startup or one in Malaysia, right? So I think it's going to be like a lot of cross-pollination of global talent. And I think also because of the depression of expectations, African talent is going to appeal to global companies from a cost perspective much more compellingly than ever before. So I think there's going to be like a mix of all these different things that are happening. And I think there's going to be some real winners, some really big winners who've got some interesting origin stories. This is the time that the fire is burning, and the phoenixes are definitely going to come out.
There's still so much to talk about in terms of, metaverse, crypto, infra, blockchain, the plays that, still grow in circumstances like this, or are getting new visibility with new funding because they're new initiatives on the continent. I don't think, sadly, we even have time to even scrape the surface of this conversation. So I think the way that I'd like to sign off on my part, Wiza, is that if there are good people out there who are looking, to get hired, or there are good companies out there that need saving and we can help in any way, let's try and do that. Let's, from a matchmaking perspective or an introduction perspective, there's no skin off my back. So happy to put good people in good places, and I'm sure Ronit will do the same. So let us know.
Yeah, absolutely. Thanks so much for that. I've got like a curated list of very interesting profiles. Anyone who's listening can reach out at wiza@thisweekinfintech.com. Happy to share to interesting founders. But yeah.
Let's do this, man. Let's do that. And thanks a lot, Wiza, and run it back to you.
Maybe just to wrap up, Wiza, you've been in tech, as you said, almost a couple of decades now, and you've done lots of startups. You still hungry about building another startup?
Absolutely. Absolutely. I've never been more psyched for the possibilities now. It's just that right now I really like the idea of a salary. It makes my personal life very comfortable. I've become accustomed to certain luxuries that I would like to maintain. And I know what it means to be an entrepreneur, but I definitely see myself, maybe 5-10 years down the road starting something. I'm just waiting for the regulatory environments to catch up for blockchain technologies in Africa, which is something I'm extremely knowledgeable and passionate about. I think there's multiple gaps that exist, and it's $100 billion volume annual opportunity. So I'm going to play it like Safaricom, wait until the regulatory environment is right. And I don't think we're quite there yet. So we'll continue earning well till then.
So we should be looking out for you to build a M-Pesa of blockchain, or the M-Pesa Web3 in 5 to 10 years time, right?
Or rather the tools to enable telcos, banks, and regulators to deploy their own M-Pesas on top of blockchain. I think that's ultimately how it plays out. And I won't even use the word blockchain, it'll just be an interoperable digital ledger.
interoperable digital ledger, IODL. Is blockchain now a dirty word? I know crypto had become one, but is blockchain?
Yeah,
so we're just going to
I
talk.
think
We're just going to talk about digital ledgers now, right? And confuse people. Like
again, I think the term has been hijacked by a lot of things that aren't even blockchains are calling themselves blockchains. And I think what's very important now is that we need to like fix the PR. We need to like lobby for this industry to make sense. And the loudest voices in the room so far have been unscrupulous actors who've lost a lot of people a lot of money. So I think we need to be as tactful as some of these players are in getting the message across. So I'm going to use the same tools and I'm going to use the same tactics, but for good instead of evil.
Excellent. Digital Ledgers for Good, brought to you by Wiza Jalakasi. Wiza, thank you so much for joining us today.
Always a pleasure on it.
Look forward to seeing you hopefully soon in person, in the flesh,